Right now, in flight school parking ramps and FBO hangars across the country, there are used training aircraft wearing price tags that would have seemed completely unhinged 5 years ago. A 1970s Cessna 172 with a mid-time engine, a steam gauge panel, and a seat cushion that's seen better decades, listed at $110,000. A 1980s Piper Warrior with no major upgrades, maybe a handheld GPS zip tied to the yoke, asking $85,000. A Diamond DA-20 that a regional flight school bought for $60,000 in 2019, turned around and sold in 2021 for $95,000, and is now sitting on a broker's listing for $105,000 with a lot fewer takers than expected. These aren't flukes, they're the visible surface of something much bigger. What happened in the training aircraft market over the last several years is one of the stranger financial stories in all of general aviation, a story that involves a public health crisis, a sudden and dramatic spike in demand for flight training, a used market that got repriced almost overnight by buyers who had money and nowhere to spend it, and a whole ecosystem of investors, flight schools, and individual buyers who made decisions that made complete sense in 2020 and 2021, and are now looking significantly less sensible in the environment that's replaced it. The headline number is $380 million. That's a conservative estimate of how much excess value got baked into the used trainer segment at the peak of the COVID-era aviation boom, specifically in the two-seat and four-seat piston aircraft used most heavily for primary flight training. That number isn't a loss yet for everyone involved. But it's a bubble by any honest definition, and right now, in 2025, that bubble is deflating. Not popping violently, not crashing overnight, but losing air in a steady, consistent way that is quietly reshaping what these airplanes are worth, who can afford to own them, and what it actually costs to learn to fly in America today. Before we get into exactly how this happened and where it goes from here, hit subscribe, because this is the kind of story that most aviation coverage doesn't want to touch head-on. The industry's marketing apparatus would prefer you think about shiny new avionics and exciting airshow debuts, and there's a place for that content. But if you want to understand what's actually happening to aircraft values, training economics, and where the used market is genuinely headed, rather than where someone's press release says it's headed, you're in the right place. Let's start at the beginning, because the origin story here matters a lot for understanding why the bubble got as large as it did, and why it's deflating in the specific way it's deflating now. In early 2020, the aviation training market was already dealing with a genuine structural imbalance. Demand for new pilots was rising, driven by aggressive airline hiring forecasts and a long-running narrative about an impending pilot shortage. Flight schools were expanding, investing in simulators, building out their fleets, and telling prospective students that getting a commercial certificate and instrument rating was a reasonably reliable path to an airline career. The used trainer market was healthy but not frothy. A decent Cessna 172 from the late 1970s or early 1980s was moving for somewhere between $45,000 and $65,000 depending on condition and equipment. A Diamond DA-40, or a well-kept Piper Arrow for the commercial and instrument crowd, was somewhere in the $80 to $110 range. These were real prices, supported by genuine supply and demand, not speculation. Then the pandemic arrived, and it did something that genuinely nobody predicted when it happened. It created, almost immediately, a massive surge in demand for exactly this class of aircraft. The mechanism was unusual. Airlines parked their fleets and furloughed pilots by the tens of thousands, which you'd think would have crushed demand for flight training, and for the first few months, it did. Flight schools shut down temporarily, the training pipeline froze, and for a brief period it looked like the pilot training industry was about to go through the same kind of demand destruction that hit almost every other travel-adjacent business. But here's what actually happened, and it happened faster than almost anyone expected. Stimulus money and enhanced unemployment benefits put real, meaningful cash in the hands of a demographic that had never had that kind of liquid capital before. Young people with no mortgage, no dependents, no expensive lifestyle commitments, suddenly found themselves with savings accounts that were actually substantial, often for the first time. At the exact same time, they had nowhere to spend it. Restaurants were closed. Travel was shut down. The concert calendar was empty. Cars and motorcycles got bought out almost immediately. And then a certain subset of those young people looked up and discovered that general aviation was still operating. Airports were one of the few places you could actually go. Flying was, by its nature, a socially distanced activity. You were in a small cabin by yourself or with one other person, outdoors, away from crowds. In the context of 2020, this was not a small selling point. The result was a wave of new flight training starts that hit the industry in mid-2020 and built into 2021 with genuinely unusual intensity. Student pilot certificate applications spiked. Flight schools that had been worried about survival in March and April of 2020 were turning students away or building wait lists by summer. And the demand for training aircraft, used training aircraft specifically, because the new airplane supply chain was nowhere near flexible enough to respond to this kind of sudden shift, went almost vertical. Think about what that demand wave looks like from the seller's side. You have a Cessna 172 you bought for $55,000 3 years ago. You've been using it for training. You've kept it reasonably well. It has an annual done. It's flying. In a normal market, you might get 60, maybe 63 for it if you were lucky, and marketed it well. Suddenly, you have 4 buyers calling in the same week, all with cash, all with urgency, none of them willing to wait for the next one to come along, because the next one is also getting 4 offers. You take $80,000 and consider yourself fortunate. 3 weeks later, that same airplane's twin goes for 87. That's how a market reprices in a hurry, and that's exactly what happened across the used trainer segment from approximately mid-2020 through the peak, which most market watchers put somewhere in late 2021 into early 2022. The repricing wasn't random. It hit specific categories of aircraft in specific ways, and understanding those categories tells you a lot about where the value is leaking out now. Two-seat trainers, the Cessna 150s and 152s, and the Piper Tomahawks and the Diamond DA-20s, got hit first and hardest. These are the aircraft that primary students fly for their first dozens of hours, and they're also the aircraft that individual buyers looking to get back into flying or get into flying for the first time gravitate toward because they're the cheapest entry point. When the pandemic training wave hit, these airplane prices moved faster and further than anything else in the segment. A Cessna 150 that was a reliable $30,000 to $35,000 airplane in 2019 was asking $55,000, $60,000, sometimes $65,000 by late 2021. A 152, which had been trading in the 45 to 55 range before the pandemic, started seeing transactions at $70,000, $75,000, even over $80,000 for clean examples with recent engine work. Those numbers matter because they set the stage for everything that's happening now. Buyers who paid those prices, whether they were individual pilots looking for a personal airplane or flight schools trying to expand their training fleets to meet demand, made a decision at a specific point in the market cycle. Some of those buyers were rational. They needed the airplane, they had the money, they understood they were paying a premium, and made peace with it. Some of them were caught up in the same urgency psychology that the low interest rate, easy money environment of 2020 and 2021 was generating across every asset class simultaneously, from stocks to real estate to cryptocurrencies to, yes, old training aircraft. They bought because the market was rising, because every week you waited cost you more, because the fear of missing out in a hot market does funny things to otherwise careful decision-making. The 4-seat trainer segment, the Cessna 172s and 172 SPs and Piper Cherokees that form the backbone of serious flight training operations, went through the same repricing with a slight lag and then kept going after the 2-seat market started to plateau. These airplanes have broader appeal because they're useful for more things beyond just primary training. They can carry a family on a weekend trip. They're the airplane you build cross-country time in. They have a longer useful life in a training fleet before maintenance economics turn unfavorable. All of that sustained demand longer and pushed prices higher. A Cessna 172N or 172P, in typical training fleet condition, meaning used hard, avionics functional but not exciting, engine somewhere in the middle of its time, had been moving for $50,000 to $70,000 before the pandemic, depending on year and specifics. By early 2022, that same airplane was being listed for $100,000, $110,000, sometimes more, and remarkably, deals were closing. Not every listing, not instantly, but deals were happening at those prices, with enough regularity to establish them as a genuine market reality, rather than wishful seller thinking. The 172 SP, which added a fuel-injected engine and became the standard training platform for the large Part 141 flight schools as they modernized their fleets, saw even more aggressive repricing because the flight school demand specifically was chasing that model. Large training academies with airline partnerships and standardized fleet requirements couldn't buy just anything that flew. They needed specific models in specific configurations. And when you have institutional buyers with real urgency and a specific shopping list, the sellers of anything that matches that shopping list exactly have enormous leverage. 172 SPs that were 100 to 120 before the pandemic were trading at 140, 150, 160,000 at the peak, with multiple buyers and competitive offer situations that felt more like the residential real estate market than anything you'd normally associate with a 40-year-old aluminum airplane. Beyond the basic trainers, the market for advanced training aircraft, the aircraft used for instrument training, commercial certificate work, and multi-engine time building went through its own version of the same story. Piper Arrows and Senecas. Beechcraft Bonanzas and Barons used for training, Diamond DA-42s and the occasional Piper Seminole in the twin-engine segment. These aircraft got swept up in the same demand wave, not as intensely and not as quickly as the primary trainers, but with the same underlying dynamic at work. Rising demand, constrained supply, buyers with money and urgency, and a market that repriced faster and higher than anyone with a historical perspective on what these airplanes had been worth for the previous decade would have thought possible. Now here's where the bubble part of this story starts to become visible, because a bubble isn't just prices going up. Prices going up can reflect genuine underlying value creation, genuine permanent shifts in demand, genuine scarcity. What makes something a bubble specifically is when prices get pushed by mechanisms that are themselves temporary, by conditions that will not persist, by buyers whose purchasing power or urgency or psychology is tied to a specific moment that won't last forever. And when you look honestly at what was actually driving the used trainer price spike, the temporary elements are right there in plain view. The first and most obvious temporary driver was the pandemic-era stimulus effect. The flush of cash that put serious money in the hands of people who had never had it before was, by its nature, a one-time event. Enhanced unemployment benefits ended. Stimulus checks stopped. The savings rate, which had spiked dramatically in 2020 as spending opportunities dried up, normalized as the economy reopened and people had places to spend money again. The demographic that had gotten unexpectedly liquid and decided to spend some of that liquidity on flight training was not going to stay liquid indefinitely, and new student starts that had been spiking were eventually going to mean revert as the population of newly liquid, newly interested potential pilots got worked through. The second temporary driver was the interest rate environment. From mid-2020 through most of 2021, interest rates were at essentially zero. Borrowing money to buy an airplane was as cheap as it had ever been. The monthly payment on a used trainer financed at near zero rates is a very different number than the monthly payment on the same airplane financed at 5, 6, or 7%, and the willingness to buy at a stretched price looks very different when the carrying cost of that stretched price is minimal. The Federal Reserve's rate hiking cycle starting in 2022 didn't just affect the housing market and the stock market. It changed the math on every financed purchase in every asset class, including used Cessna 172s, in the same direction, making the stretched prices of the bubble peak significantly harder to justify once the cost of financing them went up sharply. The third driver was the airline hiring narrative, and this one is interesting because it was partly real but also partly responsible for creating a training demand overshoot that was always going to correct. The pilot shortage story, which had been building for years before the pandemic, went into overdrive in 2021 and 2022 as airlines recalled furloughed pilots, immediately ran short, and started making headline-grabbing announcements about hiring bonuses, accelerated training pipelines, and starting pay increases that genuinely changed the economics of a professional pilot career. Regional airlines that had been paying poverty wages for years started competing with each other for pilots and passing the results of that competition through to prospective students as a pitch. Come fly for us, we'll pay you real money now, and the path from zero to hired has never been shorter. That message drove real training demand, and it was real in the sense that the airlines actually needed pilots and actually were changing pay. But it also sent a demand signal to the training market that was partially forward-looking and therefore partially speculative, based on an assumption that hiring would continue at crisis pace indefinitely, which it didn't. Airline hiring moderated, not because the shortage disappeared, but because the initial catch-up phase was always going to be the most intense period, and once the most urgent slots got filled, the pace naturally settled into something more sustainable. Students who had started training with visions of an express pathway from student pilot to ATP hire found that pathway still existed, but wasn't quite as turbocharged as the 2021 and 2022 messaging had implied. Some of them completed their training. Some of them stretched it out as life happened and the urgency faded, and a meaningful number of them, the ones who had been most motivated by the headline-grabbing fast-track narrative rather than a deep personal passion for aviation, quietly stepped back from training altogether as the environment normalized. All three of those drivers, the stimulus cash effect, the zero interest rate effect, and the airline hiring urgency effect, have now reversed or substantially moderated. And when temporary demand drivers reverse, markets correct, which brings us to what's actually happening right now. The correction in the used trainer market is real, measurable, and in many categories, it's been going on for longer than the people who are selling these airplanes want to publicly acknowledge. It's not a crash. We are not watching used 172 prices fall off a cliff overnight. What we're watching is something slower and in some ways harder to deal with than a sudden crash, which is a sustained, grinding repricing that makes every month's listing prices a little lower than the month before, that makes deals take longer to close, that puts more and more pressure on sellers who bought at the peak and are now discovering they're holding an asset worth meaningfully less than what they paid. Let me give you some specific numbers to anchor this, because talking about repricing in the abstract doesn't capture what it actually feels like to be on the wrong side of this. The Cessna 152, which was genuinely seeing transactions in the $75,000 to $80,000 range at the peak, is now moving at somewhere in the $50,000 to $60,000 range for solid examples, and less than that for airplanes with deferred maintenance, aging radios, or other issues that buyers are no longer willing to overlook, the way they were when they had to compete for every available example. That's a $15,000 to $25,000 per airplane decline from peak pricing. And if you're a flight school that bought 10 of these at the peak to expand your fleet, you're sitting on a paper loss that is very real to your balance sheet, even if you haven't sold anything. The Cessna 172N and 172P segment, the bread and butter of training fleets everywhere, has come off its peak pricing in a similar percentage range. Aircraft that were listing and closing at $100,000 to $110,000 in 2021 and early 2022 are now listing at $80,000 to $90,000, closing somewhat below that for motivated sellers, and taking significantly longer to close even at the lower prices than they would have during the buying frenzy. Specifically, the 172P and earlier models, without the fuel injection of the SP, are taking the biggest hits, because buyers who are being careful about their money are making quality comparisons they weren't making during the frenzy, and the older, non-injected models are losing that comparison against slightly newer alternatives. The 172 SP, which had become so critical to flight school fleets that it had gotten repriced almost like a commercial asset rather than a personal aircraft, is holding up a little better than the older models because institutional buyers still need them and the alternatives for standardized fleet operations are genuinely limited. But even the SP has come off its peak, and more importantly, transaction velocity has slowed considerably, meaning it's taking longer to sell even when the seller is willing to meet the market on price. The advanced trainer segment, the Arrows, the Bonanzas used for training, the multi-engine twins, has seen correction too, but with different dynamics depending on the specific aircraft and its condition. Well-maintained, properly equipped examples in this segment are holding value better than the basic trainers because the buyer pool for these aircraft isn't primarily composed of individual flight students who are sensitive to monthly payments in the same way. The buyers for a properly equipped Piper Arrow are typically experienced pilots looking for personal transportation or serious instrument proficiency builders, and that's a slightly more stable demand base. But even here, the days of multiple offer situations and deals closing above asking are gone, and sellers who need to move quickly are finding the market a lot less accommodating than it was 18 or 24 months ago. So where is the $380 million number coming from, and is it real? Let me walk through the math on this, because it's worth being specific about what it actually represents. At the peak of the market, the best estimates of the used single-engine training fleet in active circulation in the United States, meaning aircraft in the categories we've been discussing that were being actively marketed and transacted, ran to somewhere between 40 and 50,000 individual aircraft. That number includes the various 172 variants, the two-seat trainers, the Cherokees and Warriors in the training role, the advanced singles used for commercial and instrument work, and the entry-level twins in active flight school fleets. It doesn't count aircraft sitting idle, home-builts, or aircraft so old and unmaintained that they weren't really functioning market participants. Across that fleet, the average per aircraft price premium above what the pre-pandemic pricing trajectory would have suggested, meaning the premium that was attributable to the bubble conditions rather than to any real fundamental improvement in what these airplanes were worth, ran to somewhere between $7,000 on the low end for the most beaten-up basic trainers and $40,000 or more on the high end for the most sought-after SP models at the absolute peak. Blended across the whole fleet, the average excess premium per aircraft was in the range of $8,000 to $10,000. Multiply $8,000 to $10,000 by 40,000 to 50,000 aircraft, and you get a range of $320 million to $500 million in total excess market capitalization baked into the used trainer fleet at peak pricing. The $380 million headline number represents a midpoint estimate of that range, weighted toward the conservative end to account for the fact that not every aircraft in the fleet was equally affected by the bubble dynamics, and not every transaction happened at the absolute peak. That's the bubble. That's how big it was, and that's how much value is in the process of being written back down as the correction works through the market. Now, $380 million distributed across 40 or 50,000 individual aircraft sounds like maybe a manageable problem when you break it down per airplane. $8,000 to $10,000 of excess value per aircraft isn't the kind of number that wipes anyone out on its own. A flight school that paid $110,000 for a 172 SP and is now looking at a realistic exit value of $95,000 has a paper loss of $15,000 on that airplane. That hurts, but it's not catastrophic in isolation. The problem is that it doesn't live in isolation. The problem is that the same buyers who were most aggressively acquiring aircraft at the peak were often acquiring multiple aircraft simultaneously, often with financing that made sense at the interest rates that existed when they borrowed the money, but looks a lot less comfortable now that those rates have moved. And the same flight schools that were scaling up their fleets to meet the training demand wave are now, in many cases, dealing with a student pipeline that has normalized away from its pandemic peak, meaning they have more aircraft than students to fly them, which means utilization rates are down, which means revenue per aircraft is down, which means the debt service on those aircraft is being paid from a smaller revenue stream than it was when the purchase math was done. That convergence, falling aircraft values, plus rising interest costs, plus declining utilization, is the actual squeeze that the training industry is working through right now, and it's much more complicated than any single number can fully capture. Let's talk about how different participants in this market are experiencing that squeeze, because it looks different depending on who you are and when you bought. For the individual pilot who bought a personal airplane at the peak for personal use, the picture is painful but relatively contained. If you paid $85,000 for a Cessna 172 in 2021 and you've been flying it and enjoying it, the fact that its market value is now closer to $68,000 or $70,000 represents a real loss on paper, but not an operational crisis if you're not trying to sell it. You still have the airplane, it still flies, and if you can afford to hold it, the market will eventually work through the current oversupply and reach a new equilibrium. The question for individual owners is primarily whether they can continue to afford the holding costs, including insurance, hangar fees, maintenance, and the opportunity cost of the capital tied up in a depreciating asset, long enough for that equilibrium to arrive. For owners with solid income and genuinely low-maintenance airplanes, the answer is probably yes. For owners who stretched to buy at the peak and are now also dealing with higher insurance costs, because insurance across the whole GA market has moved the same direction as financing costs, the holding math is getting uncomfortable. For the small to medium flight school, the squeeze is more acute. A flight school that expanded its fleet by 5 or 10 aircraft during the demand wave financed those purchases at terms that made sense in 2021 and is now running those airplanes at 70 or 75% of the utilization rates they projected when they made the purchase decision, is experiencing cash flow pressure that shows up in very practical ways. Maintenance gets deferred a little longer than it should. Instructors who expected more hours than they're actually getting get frustrated and look for opportunities elsewhere, which creates staffing turnover that further degrades the student experience and feeds into slower student start rates, which feeds back into lower utilization. It's a self-reinforcing cycle that doesn't necessarily spiral into catastrophe quickly, but it does grind, and flight schools that were already operating on thin margins before the bubble, which is basically all of them, have very little cushion to absorb months and months of that grinding pressure. The schools that are most exposed are the ones that specifically overexpanded in the categories that have corrected the most. A school that acquired a fleet of 150s and 152s at near-peak pricing is sitting on the most deflated segment of the market, in aircraft that are now also aging into maintenance intensiveness at exactly the wrong moment. The combination of lower market value on exit, higher maintenance costs going into the next annual, and students who have more options than they did at the peak because competing schools haven't all closed is a genuinely difficult operating environment. Larger training academies, the Part 141 operations with airline partnerships and institutional infrastructure are somewhat better positioned because their cost structure is built around volume in a way that small independent schools aren't, and their connection to the airline pipeline provides a more stable demand base. But even these larger operations are not immune from the correction dynamics. They're the ones who most aggressively acquired 172 SPs at the peak of that model's premium pricing, and their fleet values are reflecting the correction just like everyone else's. Now let's talk about the individual investor class that entered this market during the bubble, because this is a part of the story that doesn't get discussed openly very much in aviation circles but is very real. During the 2020 through 2022 period, general aviation aircraft, including used trainers, started attracting a category of buyer that hadn't been particularly active in this market before. Call them aviation-adjacent investors, people who weren't necessarily pilots themselves or weren't primarily buying for personal flying, but who saw the strong price appreciation trend and the genuine demand narrative around the pilot shortage, and decided that used training aircraft looked like a reasonable asset class to put some money into. The idea, stated plainly, was to buy an aircraft that was appreciating, lease it back to a flight school or an FBO, collect income from the leaseback while the asset appreciated, and sell for a gain once the run had played out far enough. This is not an unusual financial structure in general aviation. Leaseback arrangements between individual aircraft owners and flight schools have been part of the industry for decades. They work, more or less, when the underlying asset is fairly valued. The income from operations is sufficient to cover carrying costs, and both parties have aligned incentives for keeping the airplane maintained and utilized. What was unusual about the COVID-era version of this trade was the layer of price speculation sitting on top of an otherwise functional structure, the assumption that the appreciation trend that had gotten buyers into the market would continue long enough to generate a meaningful capital gain on top of the leaseback income. That assumption was always the fragile part of the thesis. Leaseback income from a used trainer is not particularly high relative to the capital required to own one. A Cessna 172 generating leaseback revenue at a typical flight school rate of $100 to $120 per Hobbs hour, running at some realistic utilization level after you account for maintenance downtime and scheduling gaps, might generate somewhere between $15,000 and $30,000 a year in gross revenue. After operating expenses, the net to the aircraft owner is a lot thinner, and that's before debt service on a purchase that happened at $110,000 at a 7 or 8% interest rate. The math on leaseback as an income play was never particularly compelling on its own, which is why the investors who entered this market were always counting on the appreciation component to make the overall return work. Remove the appreciation, add a correction, and the investment thesis comes apart fairly quickly. An investor who bought a 172 at $105,000 has been running it on leaseback for 2 years and is now looking at a realistic exit value of $85,000 or $88,000, has not just lost their expected capital gain. They've lost a meaningful chunk of their principal, and depending on the leaseback economics and whatever they paid for maintenance and unexpected repairs, they may have lost more than that on a net basis even before accounting for the opportunity cost of the capital. This investor class isn't enormous, but it's meaningful in terms of market dynamics because these buyers are more motivated to exit than owner-operators are. A pilot who bought a 172 for personal flying can hold it indefinitely if the numbers allow. An investor who bought it as a financial asset and is watching the return thesis deteriorate has both more motivation to sell and, because they made the purchase as a financial decision rather than a personal one, more willingness to cut price to exit cleanly, rather than hold out for a number that isn't coming. That seller motivation is one of the reasons the correction is happening as steadily as it is, because you have a meaningful cohort of sellers who are more willing to meet the current market than traditional aircraft sellers tend to be, and their listings are setting price points that other sellers then have to compete against, which pulls the whole market down in a gradual but relentless way. Let me walk through some of the specific pressures that are accelerating the deflation beyond just the demand normalization story, because there are several distinct forces at work simultaneously, and understanding them separately matters. The first is the insurance market hardening that's hitting general aviation across the board. We've talked about this in the context of new aircraft and in the context of high-performance singles, but it's hitting the training aircraft segment just as hard in ways that are specifically relevant here. Insurance premiums for training operations have moved up significantly over the last 2 to 3 years, both for the schools that hold the operational policies and for individual owners who are flying their aircraft in a training or rental role. Underwriters have gotten pickier about the age and airworthiness of training fleet aircraft, about minimum maintenance standards, about the experience requirements for pilots renting or using the aircraft. All of this adds cost to the ownership equation and reduces the pool of buyers who can qualify for coverage at a price that makes economic sense. For the used trainer market specifically, the insurance hardening creates a double pressure. On the cost side, it makes owning these aircraft more expensive for everyone, which reduces the universe of viable buyers. On the value side, it specifically penalizes older aircraft and aircraft without recent avionics upgrades, because underwriters are increasingly willing to cover a 172 SP with a Garmin G1000 on terms that differ meaningfully from what they'll offer on a 1977 172N with original steam gauges. That differentiation, which is genuinely new in terms of how strongly it's being applied, is creating a wider and wider gap between the top of the used trainer market and the bottom, with the older, less equipped aircraft declining fastest and the better equipped, more recent examples declining from a higher peak but holding relative value somewhat better. The second pressure is the maintenance cost escalation that has hit all of general aviation, but is particularly punishing for aircraft that were bought at stretched prices during the bubble. Parts prices, labor rates, and the cost of any meaningful airframe or engine work have all moved significantly over the last several years, driven by supply chain disruptions that affected aviation parts manufacturers, labor market tightness that hit aircraft mechanics just like it hit every other skilled trade, and a general inflation cycle that wasn't kind to any business that depends on physical materials and specialized human expertise. What this means in practice is that the annual maintenance budget for a training category aircraft has gone up meaningfully from what it was when buyers were doing their purchase math in 2020 and 2021, and the airplanes themselves are now older, meaning more of them are hitting time-intensive maintenance intervals simultaneously. An aircraft bought at the peak of the market, now 2 or 3 years into ownership, may be coming up on an engine overhaul or a major airframe inspection that pushes the ownership economics from uncomfortable to genuinely difficult, and at that point, an owner who was borderline on holding the asset finds themselves in a forced seller situation that adds more motivated inventory to an already buyer-favored market. The engine overhaul issue specifically deserves attention because it's one of the clearest examples of how the bubble dynamics created a hidden liability that's becoming visible now. During the buying frenzy, a lot of aircraft changed hands quickly and without the kind of meticulous pre-purchase inspection that a buyer in a normal market would insist on. Buyers who needed to move fast, who were competing against other buyers, who were afraid of losing the deal, sometimes accepted airplanes with engines closer to overhaul time than they would have in a less frantic environment, or with maintenance issues that got disclosed in logbook entries but not fully processed in terms of what they meant for the cost of ownership going forward. Those deferred decisions are now arriving on schedule. Engines that were mid-time at purchase are now at or near their recommended overhaul interval. The bill that was always coming is now here, and it's arriving in a market environment that is far less forgiving of a seller trying to price through that cost than the environment that existed when the airplane was acquired. The third pressure is structural, and it gets into the fundamental nature of what these airplanes actually are as economic assets over the long run. A used Cessna 172 from the 1970s or 1980s is not an appreciating asset in any meaningful sense outside of the specific, temporary conditions that created the bubble we've been describing. It is an aging machine made of aluminum and rubber and wire, with a certified engine whose overhaul costs money regardless of how many hours have gone on it, sitting in an environment of corrosion and thermal cycling and ultraviolet exposure that is quietly degrading it every year it sits on a ramp. The maintenance complexity and cost for these aircraft increases with age in a way that is relentless and predictable. Airworthiness directives accumulate. Parts that were cheap when the airplane was young become scarce or expensive as the production line closed decades ago and the existing inventory of spares gets worked through. The avionics technologies that made a 1970s panel functional are now so old that the technicians who know how to work on them are retiring, and the replacement cost of bringing a steam gauge panel up to anything remotely modern is substantial. All of this means that the price range where a late 1970s or early 1980s 172 makes economic sense as an owned asset has a real ceiling, and that ceiling is significantly lower than where these aircraft were trading at the peak of the bubble. When the market was moving fast and buyers were acting on urgency and emotion, that ceiling got ignored. Now that buyers are moving slowly and doing math, the ceiling is back, and it's pulling prices toward it from above. This is the part of the story that makes the bubble's deflation more certain and more lasting than a temporary softness in demand would produce on its own. Even if pilot training demand tomorrow somehow returned to its 2021 peak, which it won't, the structural economics of what an aging aluminum trainer is actually worth to own and operate put a lid on where prices can rationally go. The bubble peak pushed well through that ceiling. The question isn't whether prices fall back to the ceiling. They will. The question is whether they stop at the ceiling or overshoot below it in the other direction, as corrections sometimes do. Right now, the evidence suggests we're still in the falling toward ceiling phase rather than the overshooting below it phase. Prices are down meaningfully from peak but haven't dropped below what you'd calculate as a rational long-run value for these aircraft, based purely on their utility as training tools and personal transportation at current operating costs. That's the constructive read of where we are, and it's probably accurate for most of the segment. What would cause the overshoot scenario? A significant economic downturn that pushed discretionary spending broadly lower, because flight training is ultimately a discretionary purchase for the large majority of students starting training today. A sudden and severe tightening of insurance availability, not just price increases, but actual withdrawal of coverage from parts of the fleet, which would remove a chunk of potential buyers from the market entirely. A rapid acceleration in the certification and adoption of the next generation of training aircraft, whether that's the emerging electric trainer segment or some other technology that genuinely replaces the 50-year-old airframe as the standard training platform, though that transition is moving slowly enough that it's not an imminent risk. Any of those could push the correction past the rational floor and into genuine distress pricing. None of them is happening right now, but none of them is impossible to imagine either. For the flight training industry as a whole, the used trainer bubble's deflation is creating some practical pressures that are worth understanding separately from the pure asset value discussion, because they affect students and instructors and schools in ways that matter for aviation's future. Flight school economics have never been comfortable, and the combination of peak-priced asset bases, higher financing costs, and normalizing student demand is making them actively difficult for a meaningful portion of operators right now. The schools that will navigate this best are the ones that bought conservatively during the bubble, or not at all, have low debt relative to their fleet value, and built their marketing around quality of instruction and student outcomes, rather than just availability of capacity. The schools that are most at risk are the ones that overexpanded aggressively at peak pricing, financed heavily, and are now finding that their revenue per aircraft is declining, while their debt service is fixed at the old, more expensive cost basis. What this means for students currently training or considering training is nuanced. On one hand, the normalization of demand means flight schools that were turning students away or building waitlists during the peak are now competing more actively for students, which creates some genuine buyer leverage in terms of negotiating pricing, comparing quality, and not feeling forced to accept whatever school happens to have the next available slot. On the other hand, schools that are under genuine financial stress are cutting costs in ways that can degrade the training experience, whether that's deferring maintenance slightly longer than they should, hiring less experienced instructors to hold payroll costs down, or reducing the number of aircraft in their fleet to the point where scheduling becomes difficult for students. Neither of those outcomes is good for training quality, and students shopping for a flight school right now need to be asking questions that would have seemed overly cautious during the boom. Ask a prospective flight school when their training aircraft had their last annual inspection and ask to see documentation, not because you're expecting to find fraud, but because a school that's proud of their maintenance will produce that information immediately and without defensiveness. Ask about instructor retention, specifically how long the average instructor at the school has been there, because a school with rapid instructor turnover is a school with an instruction quality problem regardless of what their marketing says. Ask about their aircraft utilization rate, how many hours per month their typical training aircraft flies, because both very high utilization and very low utilization create problems. Very high utilization, which was the problem during the peak, means the airplane is getting worn faster than it can be properly maintained. Very low utilization now, at a school that's dealing with declining student numbers, means the school's revenue base may be insufficient to sustain the quality it's advertising. For instructors, the current environment has a specific flavor that's different from both the pre-pandemic normal and the frenzied demand of the peak. The instructor shortage that everyone was alarmed about in 2021 and 2022 hasn't disappeared, because the structural pipeline from student pilot to flight instructor to regional airline hire is still being worked through by a large cohort who started training during the boom. But the hiring pace at the regional level has moderated enough that the absolute urgency to build hours through instruction and get to the regionals as fast as possible has eased somewhat, which has some counterintuitive effects on the instructor labor market. Instructors are less likely to sprint through a few hundred hours of instruction and immediately jump to a regional job, which is good for flight school continuity. But they're also a little more selective about where they work and what they accept, which means schools that can't offer a reasonable workload and reasonable pay are finding the instructor market tighter than the simple supply-demand numbers on students versus available instructors would suggest. Now let me talk about where this goes from here, because the most useful thing we can do with a market analysis isn't just to describe what's already happened, but to think clearly about where the correction leads. The most likely trajectory for the used trainer market over the next 12 to 24 months is continued gradual deflation from current prices, with the pace of that deflation slowing as we approach a new equilibrium price level that reflects current interest rates.